It is my pleasure to introduce the keynote speaker in our 2025 International Credit Rating webinar. He is Professor Mahesh Kotecha, the President and Founder of Structured Credit International Corp, SCIC, based in New York, specializing in capital and emerging markets and credit rating, particularly for African clients and others. He has extensive experience in the industry, having served as Managing Director at MBIA Insurance Corporation and Capmark, and a head of sovereign, supranational, and structured finance rating at Standard & Poor's for nearly a decade. His career also includes role at Federal Reserve Bank of New York, where he advised foreign central banks on the management of the US dollars reserves, and UNFPA as an adjunct senior fellow at the Council on Foreign Relations, 1999 to 2002. Kotecha advocated for sovereign credit rating in Africa, influencing major initiatives in this area supported by the UNDP and the US State Department. He holds an MS from MIT Sloan School and BS from Harvey Mudd College, and is a member of the Bretton Woods Committee and the International Advisory Panel of the East African Development Bank, and a CFA. He is a member of the Concilium of UNDP's Africa Credit Rating Resource Platform. Born and raised in Uganda, Kotecha attended Jinja Secondary School and again Khan Secondary School in Kampala before pursuing higher education in the US. He is the author of a book, The River Finds Its Course, December 2023, and numerous articles on credit ratings and capital markets. Ladies and gentlemen, please join me to welcome Professor Mahesh Kotecha, the President and Founder of Structured Credit International Corp, SCIC, as I invite him to deliver the keynote speech.
Thank you very much, Dr. Nwoga, the MC. Can you hear me okay?
Thank you. Go ahead, please.
Okay, thank you very much. I'm very pleased to join the distinguished ladies and gentlemen in the audience and those who have preceded me as speakers and those that will succeed me. It's a great honor to deliver this keynote address at DataPro's International Rating webinar, I believe the fifth, and at the occasion of the 30th anniversary of the founding of the DataPro agency. My congratulations to all those who participated in this huge success. I thank the organizers for inviting me and commend DataPro for its important contributions in strengthening the Nigerian credit rating landscape and actually beyond Nigeria. The theme before us, leveraging credit ratings for economic growth in developing countries, comes at a critical time. I just listened yesterday to Kristalina Georgieva, the managing director of the IMF, at her kickoff session for the World Bank annual meetings, which I'll attend next week in Washington, D.C. She noted the great importance today of fostering capital flows from internal sources in Africa when pressures are strong on the international markets that restrain capital flows, both because of risk and because of market conditions. Both advanced and emerging economies face profound fiscal and financial challenges. In 2001, I was invited by the Stockholm School of Economics in Riga, Latvia, to give a lecture on local credit rating agencies, much like this one. At that time, my firm was exploring the possibility of setting up a Baltic area rating agency for 3 or 4 countries in the region, Latvia, Lithuania, Estonia, which we decided not to do then. But the invitation reflected a growing recognition even then, 25 years ago, that ratings could play a transformative role in the development of local capital markets and the development of credibility of emerging economies, which Baltic states were at that time, and to some extent still are. So I want to first talk about the tale of 2 fiscal paths. We fast forward to today. In a recent commentary, I described the contrasting stories of 2 nations at different ends of the fiscal credibility spectrum, United States and Nigeria. Moody's earlier this year in May removed the last AAA rating on US, in a stark reminder that even the world's most privileged credit story can be eroded by political dysfunction and mounting deficits. Prestige or might alone cannot shield a nation from the consequences of poor governance. Meanwhile, Nigeria is climbing back from the brink. Moody's and Fitch both upgraded Nigeria, reflecting improved institutional credibility, fiscal reforms, and a revamped policy framework. The markets responded. Spreads on Nigeria's 1931 Eurobonds narrowed by over 250 basis points. That's very, very high shift with one notch change in the rating. Almost unprecedented. Even as U.S. Treasury spreads widened by 50 basis points owing to the downgrade by Moody's of the U.S. rating. The common message is clear. Governance matters. It's not just in theory, but in credit ratings, in borrowing costs, and ultimately in the confidence of investors. So now we turn to the role of credit rating agencies, which has been described to some extent already by the Director General of the SEC and by others preceding me. Credit ratings are not just a numbers game, although DataPro knows numbers. They are independent and credible opinions of creditworthiness, the ability to repay your debts on time as due. Use information asymmetry, provide common language between issuers and investors, and reinforce transparency and discipline in financial management. They assess whether the investor will get repaid its investment on time as scheduled. That's critical, on time and as scheduled. For issuers, ratings lower borrowing costs, broaden investor base, enhance credibility. For investors, they provide benchmarks, comparability, and enhance liquidity. For the system as a whole, ratings deepen financial markets, enable financing, and supplement regulations. Ratings thus occupy a unique position in global finance, both a reflection of fundamentals and a catalyst for reform. And they are a private sector initiative, which is remarkable because of their role, which is quasi-regulatory. My experience with rating agencies has been mentioned already, but let me just highlight a few things that are relevant today. My journey has given me direct experience with rating agencies beyond the global big three. I was, as mentioned by the MC, at Standard & Poor's for nearly 10 years, running a major part of their international rating activities, supranational sovereigns and all public sector. So in this particular case, I want to talk about my local rating agency experience. In Colombia, after leaving S&P, I invested in BRC Ratings, one of the country's leading credit rating agencies. I served on its board and its rating committee, particularly for structured financings and certain other financial institutions. And after more than a dozen years actually, of involvement, we sold the company to Standard & Poor's at a nice multiple. And it has integrated the agency into its global rating platform and continues to operate today. Today, I'm also an investor in Turk Rating, an independent rating agency in Turkey, where I served on the board for some years and remain a shareholder. These experiences shown me firsthand both the promise and the challenges of building local rating agencies, how they can provide invaluable local insight and encourage long-term investment in infrastructure, as in Colombia, but also how difficult it can be to gain recognition and acceptance from local and global investors. So I really commend DataPro for the journey that they have undertaken for 30 years. That shows guts, it shows persistence, it shows patience, and it shows professionalism. I congratulate you. Ratings and economic growth. This is a very important issue. Why do ratings matter for economic growth? Is because stronger ratings attract long-term private investment and reduce borrowing costs. Nigeria is in a very interesting position with a capital market in Africa which has few parallels. South Africa, Kenya to some extent, but then Nigeria. And you have, of course, CFA zone in the Yomwa region and to some extent in the CEMAC region. But Nigeria's capital markets are really quite robust, and they actually protect its ability to borrow and maintain fiscal soundness in the pressure under stress of fiscal deficits. That frees up public resources for governments to invest in infrastructure, education, and healthcare because there is private capital available. Sovereign ratings also encourage governments to adopt sound fiscal management and structural reforms. They reward transparency and credibility. For corporates, they open doors to global capital and facilitate innovation and growth. In short, ratings are not a substitute for policy, but they can be a powerful reinforcement of good policy. They can underline that the policies are good or point out that they are not. And both have consequences. They can amplify the benefits of reforms and discipline the costs of inaction. Now, Africa's experience with ratings is two and a half decades long, and I've had some role in that. My involvement began with the first rating of African Development Bank in 1984. I was the party on the other side of Babakar NDI and Kira Peabody, which was their investment advisor, and I was at S&P. We did that rating in 84, and then not much happened in other new ratings in Africa for a while. In the early 2000s, very few African governments had sovereign ratings, about two or three, Mauritius, one or two others. That changed when UNDP and the U.S. State Department financed the first sovereign ratings by Standard & Poor's and Fitch, respectively, for African sovereigns. This was encouraged in part by a roundtable on capital flows on Africa to sub-Saharan Africa, which I directed at the Council on Foreign Relations, a U.S. think tank, and which recommended that African governments seek such ratings. The Assistant Secretary of State from the U.S. State Department, Walter Kansteiner, was a speaker at my invitation at that conference, and Zephyr Diabre, who was formerly Minister of Finance of one of the African countries, I believe Mali, or Burkina, I'm not sure which one. He was at the UNDP as Assistant Administrator, and he was a member of my roundtable. Both took up the matter with their respective organizations and funded the first ratings for African governments, partly thanks to our work together. And today, over 30 African countries are rated by at least one rating agency of the big three. And Morocco has just been upgraded to investment grade, the third African country to be rated investment grade by S&P earlier this year. These ratings have helped catalyze African Eurobond market with over 2 decades has issuances that exceed $300 billion, with about 2/3 of that outstanding today. So actually, the original issuance might even be closer to 400 billion, although I don't have numbers on that to document that. Ratings have become not only a passport to international markets, but also a benchmark for investors on governance and reforms. Yet there are challenges, especially for African governments. Too few African countries have investment-grade ratings, and they remain vulnerable to commodity cycles, political instability, and fiscal stress. Some methodological challenges and data limitations add to difficulties. For example, African economies tend to be commodity dependent, Nigeria with oil, for instance, and have large informal sectors which do not generate much government revenue. The women of Nigeria are famous for their entrepreneurship, which increases fiscal deficits because the revenues are not captured in the private sector revenues are not captured in government revenues. So fiscal deficits are higher than they might be otherwise. And that's a key sovereign ratings metric. Debt statistics of some governments are also not reliable. An example is Senegal. In October last year, they certainly found that they had more debt than they thought. They disclosed that to their credit, and it led to a couple of downgrades for them because debt was higher than thought, quite significantly. Cross-border trade, some illicit and some not, is also prone to understatement in national trade statistics because this trade that goes on between the borders of Nigeria and Togo, for example, much of that in the old days was oil bought at cheap prices in Nigeria and sold at higher prices across the border for private profit. That's not reported, and that therefore is not captured in the national statistics, and therefore doesn't affect the ratings, which is a pity. So these are understatements of strength that need to be brought out into the open and documented and add value for the ratings. And there are others. Of course, African governments remain weak in their level of development, their GDP per capita, the economic structure, which is relatively less diverse. Nigeria is very oil dependent, although non-oil exports are rising. External balance, which tends to be dominated by a few export commodities and large amounts of imports for food and fuel, and limited buffers against event risk. So these limit the ratings and have kept them at non-investment grade level for many, many countries in Africa. Nonetheless, progress is being made, and African sovereigns are able to borrow, even with their ratings at the levels that they are at. Success stories among the African countries are worth mentioning because we need to benefit from our successes and emulate them. Mauritius and Botswana remain Africa's two investment-grade sovereigns, apart from Morocco, which I just mentioned is the third now. Their success reflects more than luck. It reflects prudent policies, strong institutions, and political stability. Mauritius diversified from sugar into tourism, financial services, and IT. One of my teachers in high school would say he had visited Mauritius, and people would have at the door, leaving the door, they would have a bowl of sugar. And as they were entering or leaving the house, they would just take a little fist full of sugar and just eat it. So that's changed, no doubt. They've diversified into IT, maintaining prudent debt ratios, and have attracted investment in the financial sector and also in IT, in electronics. Botswana carefully managed its diamond revenues from the very beginning, running budget surpluses and investing in resource-based windfall from the diamonds wisely in infrastructure, education, and healthcare. I commend the rulers, the governments of Botswana over the years for having had the foresight, integrity, and the confidence over a long period of time to do that for their people. That credibility has translated into investor confidence, including investment-grade rating, lower borrowing costs, and sustainable growth. The lessons are not unique, they are replicable. If governments commit to governance, good governance, transparency, and reform, they will get rewarded. But of course, there are challenges. Developing countries have formidable obstacles: volatile capital flows, shallow domestic markets, dependence on commodities. AGOA has just been terminated by the US, and the tariffs are a big burden on many countries. Local credit rating agencies also face challenges. Their credibility is difficult to establish, and I think it's a great job that DataPro has done to establish its credibility. Resources and investor recognition are also limitations. As experience has confirmed, local agencies can succeed if they're independent, professional, and well supported by regulators, which the DG mentioned it does at the SEC. The dominance of the big three agencies, Moody's, Standard & Poor's, and Fitch, remains a reality. But African agencies like DataPro are increasingly demonstrating their relevance by providing local perspectives that local and global investors can trust. Yet let us also be candid. The pathway for a new rating agency is not easy. African Union, for example, has proposed establishing its own rating agency to provide a more balanced perspective on African economies. The idea is compelling, but such agencies will need to overcome skepticism from international investors, demonstrate true independence, and build the analytical depth to be credible initially in the region, in the regional capital markets, and eventually in the global capital markets. I can personally attest that success requires more than good intentions. It demands governance, professionalism, capital, and above all, the ability to earn trust over time. When I started out at S&P, for example, we were not present in the Eurobond markets. I was at the first rating seminar we set up in 1980, December, at the Savoy Hotel in London. So it was a long journey, even for the big three. Without this, new agencies risk being seen as political projects rather than credible market participants. And I think this is a risk that AU should bear in mind. Let me also address a recurring issue in African ratings debate, the so-called African risk premium. There's a school of thought at the African Union and elsewhere that African ratings are too low because they are driven by a misperception of African risk. Let me just put it bluntly, there's a bias. I don't think there is, but there is a perception that there is. It is true that advanced economies benefit from high ratings that allow them to borrow cheaply, while many African sovereigns face elevated borrowing costs even when fundamentals improve. UN Economic Commission for Africa has pointed to liquidity risk as one factor, and Vera Songwe, its former Director General, has proposed a liquidity support facility to help mitigate this and has got funding to do that. But that's a huge task because liquidity doesn't come with a few $100 million. It takes billions and billions for liquidity. African Union and others have proposed another solution, establishing an African rating agency to provide an alternative, presumably unbiased ratings. Such an initiative is not without merit, provided it can gain traction with investors through independence and credibility. After all, local investors in China, Japan, India, you will speak to CARE, which is an Indian rating agency, Malaysia, and Nigeria, among others, pay close attention to their own rating agencies, but credibility is everything. An agency that assigns higher ratings than the big three without the same rigor risks being discounted by investors in the global investor markets. The real benefits of ratings are not in flattering grades, but in the discipline they impose, forcing countries and companies to learn the ropes, improve performance, and ultimately earn the ratings they deserve. There is indeed a role for an Africa-focused rating agency, especially for investors who concentrate on African borrowers and seek relative assessments across this universe. Africa, it is said, has $2 trillion of funding available in its pension funds and sovereign wealth funds and other sources of institutional money. We need to tap that, and local rating agencies are the best means to do so. Yet international investors will continue to rely primarily on established agencies until any new African initiative demonstrates independence, rigor, and transparency to gain lasting international influence. The path forward, well, it's first, local agencies must be strengthened and continue to be in business. So I commend DataPro's journey and that of others like it. And I'm glad to see DataPro fostering regional cooperation among other agencies that are active in the area. You have invited several of your peers to attend and speak at this event, which is very, very, very good. Second, enhanced transparency, which is a continuing challenge. Improved data quality, also a continuing challenge, and it's been mentioned that DataPro is looking at artificial intelligence. I talked to Standard & Poor's just two weeks ago at an alumni reunion, and a senior executive of S&P said they are looking at artificial intelligence. Of course, it's a threat to individual analysts. Will their jobs be taken away? I don't think so, because ratings are not simply a numbers game, as I said before. They are a combination of data and judgments and experience that gives the judgments. So the second challenge is not only to enhance transparency and improve data quality, but also build capacity in government ministries and companies to engage with the rating agencies effectively. UNDP is working on this project. I'm a member of their concilium, and I commend to you the platform that they have set up for African governments to benefit from education on how ratings are done and how to improve performance with presentations to and results from the rating agencies. Third, deepen the domestic capital markets, where Nigeria is making great progress, but more has to be done. So ratings do not just serve international investors, but also help mobilize local savings for local development. Fourth, support the development of African-owned rating initiatives, but ensure that they are built on principles of independence, analytical rigor, and market trust, not political expediency. And finally, commit to good governance, because the lesson both of the US downgrade and the Nigerian upgrade that I mentioned is that governance matters. Sound policies, institutional integrity, and reform credibility are what investors ultimately reward. So to conclude, ladies and gentlemen, credit ratings are not perfect, but they are indispensable. They can open doors to capital. They can discipline governments and companies, although that's not their particular aim. They aim to provide information to investors. These are indirect effects. And they can reinforce sound policy choices, again, as a side effect. If leveraged wisely, they can help transform the growth trajectories of developing countries, including Nigeria. But without governance and reform, even the mightiest sovereigns can falter, as they have. France was downgraded just a few weeks ago by Fitch. The challenge and the opportunity is before us. Nigeria has a chance not only to benefit from stronger ratings, but also to lead in shaping Africa's financial future through development of local capital markets and local credit rating agencies. Let us ensure that ratings are not just scorecards, but bridges to resilience, transparency, and sustainable growth. I thank you very much for your attention.
Much, Professor Mahesh Kotecha, the President, Structured Credit International Corps, SCIC, for your wonderful keynote address. You've been able to give us the tale of the two fiscal parts, which has to do with the United States and Nigeria, one having a downgrade while the other having an upgrade. But in all, you've also been able to show your experience cutting across jurisdictions, having a root in Africa, and then ending with the US and still having an eye in African development. I can say you have really put across today your huge expertise and experience. And you have also pointed out that credit rating agencies help to open up the space, especially in our world today that has become borderless, facilitated by technology, and that there is need to also look at data integrity, data quality, and that local content, especially when it comes to the African risk premium, should also be looked at in order to strengthen whatever is being done across Africa to align with global standards, to be able to bring and then build the credibility and integrity it deserves. On that note, I want to sincerely thank you so much, Professor Mahesh Kotecha, for this wonderful keynote address. Thank you so much.
Thank you for the opportunity.